FDIC insurance only covers deposits up to $250,000. Well, obviously, the state has far more money than $250,000. So that insurance is not going to help them. Meanwhile, the state is going to have to, it's quite expensive to get FDIC insurance. They'll be paying a lot of money basically to bail out other banks. And they will now be under the thumb of the FDIC, which is basically a bunch of other banks. And if those other banks decide they don't like our bank, they could try to put us into receivership for some reason.
How would that manifest itself, Ellen?
Well, let's say California had its own bank, and California was making loans to itself. And let's say some credit rating agency that was funded by big Wall Street banks decided that this was not a safe and sound practice, that we shouldn't be lending money to ourselves, and therefore they downgraded us. It would just give them all this leverage that we don't need to give them because we don't need their insurance. It's not going to help us, and it will hurt us.
Don't we as depositors somehow have a psychological comfort zone when we think, oh, FDIC insured? There's a lot of people that lost their money a few years ago and they couldn't get their money back. Won't people think, well, you should have some insurance policy? What do you say to that?
You're not going to have your money in the bank. It's the state that has its money in the bank. And the state of California could be the most highly capitalized bank in the world. This would be the soundest bank in the world. The Bank of North Dakota is extremely sound. I mean, the state itself would have to go bankrupt for its bank to go bankrupt. It's not a risk. I mean, it's no more risk than to be the state.
Let's take California, for example. Some people will say California is running out of money. Do you accept that or do you not accept that?
No, it's absolutely not broke. Just in CalPERS, the state pension fund, we have $200 billion. That's more capital than any bank in the world has. I'm not counting central banks, of course, which can create money. And that's just one fund. And then you have, I think there's $71 billion in the investment pool managed by the treasurer. And then there's something like $200 billion in real estate owned by the state. I mean, they have a ton of assets. And California itself is very rich in resources. We're rich in labor. We're rich in brains, manpower, skills. At one time, we were rich in education, although the education's falling off. So we've actually got everything. The only thing that makes it look like we're broke is that we have this requirement of balancing the budget. And because of the banking crisis, the Wall Street banking crisis, people have lost their jobs and they're not paying the kind of taxes they used to pay. It's the same as in every other state. The tax base has fallen off. And meanwhile, the state is required to pay more out than they ever have been because you've got unemployment and all the things that happen in a depression. We're simply not working the depression right. First of all, we shouldn't have a balanced budget amendment. The funny thing was Governor Schwarzenegger went way over budget one year, and so they passed this simultaneous law that said, well, I can do it. I can go heavily into debt, but it's on condition that no other governor after me does it. So that's why we have this balanced budget amendment. But we should revoke that because there's no need for a balanced budget. It's only the interest that even costs anything for the state to go into debt. And if you can fund your own debt through your own state bank, you won't have an interest charge. Now, if, let's say, the rating agencies don't approve of the state funding itself, using its own deposits and its own capital to create credit to lend to itself, then you can use that same capital and deposit base to create credit to lend to municipal governments. And so you buy the municipal bonds. Let's say you bought municipal bonds at 5%. By my calculations, California has enough capital and enough deposits to create loans of $150 billion. I mean, we're only $25 billion in the red. We can create loans of $150 billion. So let's say you use that $150 billion to buy municipal bonds at 5% interest. So that would pay $7.5 billion in interest per year. Well, that's easily enough to service the $25 billion deficit. That would be enough to pay 25% interest. So you could service the deficit and do a lot more besides with that money.
I have a question about the concept of the state-owned bank from the view of citizens of the United States. They understand that private banking has practically defrauded the American people and continues to act irresponsibly and with criminality, in my view. I'm stating that. However, when you create this apparatus like the Bank of North Dakota and you begin to have state banks, what about people who say if they're state run banks, then state run politics will be at the helm of these banks doing the things they're not supposed to be doing and acting very much as inept and inappropriate as our Congress and senators in our administration, whether it's on the left side or the right side, it doesn't matter. It'll be a replica of. How do you deal with people's concerns about that?
That's why we're so fortunate to have this model in the Bank of North Dakota, because we have retired people from the Bank of North Dakota that are consultants for us in the Public Banking Institute. And these are the most honest, well-intentioned, down-home sort of people. It's all family to them. You know, they're using the bank for what needs to be done in North Dakota. They're using it to serve the needs of North Dakota. Nobody gets any bonuses out of this deal. There's no advantage to them to churn loans. They have no motivation to make bad loans. And so they're very conservative. They only make good loans. And they extend a credit line to the state itself. There was 1 year in the last decade that the state went a little over budget. And so they just used their credit line with the Bank of North Dakota, which is their own bank. And then the next year they got back on track. They used this credit to bail out, for example, there was a huge flood in the Fargo area, and the bank just stepped in. And first of all, they put a moratorium on foreclosures on the homes in the area, and they provided disaster relief so that they didn't have to wait on FEMA. They were right there with their own funding. And they have the state agency, and its purpose is to fund infrastructure. So I was asking where this agency got their funding, and I was told, well, they're guaranteed by the Bank of North Dakota. Now, it happens that the agency is just two guys who happen to be in the Bank of North Dakota. In other words, they're right across the hall from each other. So they're just using their money for what they need the money for. And I said, well, but where do you get the actual funds? And they said, we have different funds around that are sitting idle, and so we just draw from those. So they just do the practical thing. You know what would happen in California. Somebody's going to say, oh, no, you can't use that money. That money's been earmarked for this or that. But in North Dakota, their goal is to serve the state. Nothing else. That's their job. They're looking for how they can help the state, and that's what they do. There's no way that they can use that for their own self-interest because it's just not in the way the law is set up. There was the Commonwealth Bank of Australia that I would consider the most brilliant model. I mean, it followed basically the Bank of Pennsylvania, which is the original model. The colonial Bank of Pennsylvania set up by the Quakers in the turn of the 18th century, beginning of the 18th century. And so what they did was basically just issue money and lent it to the farmers. And then the money came back, and then they issued a little extra, and that was enough to cover the interest, and they used that for the expenses of the government. And so the interest basically paid for the government, so they didn't have to pay taxes. Well, they did that in Australia, Commonwealth Bank of Australia, in 1912 when there was a global depression because in the 1890s there was a huge banking collapse. So in Australia, instead of setting up the Federal Reserve like we did, they set up a publicly owned bank. And the bankers were concerned about this, and so they made sure that they had one of their banker people in charge. Because he was a banker, he knew how banking worked, and he decided to use this for the benefit of the country. And so the banking cartel group came and said, well, you're going to need some funding for us. You'll need to borrow from us because they expected to get control that way. And he said, no, we're not going to need any capital. We're just going to lend the credit of the nation because that's the way banking works. We're just going to lend credit. And that's what they did. And that was before, the Bank for International Settlements had all these capital requirements, et cetera, these ways that they break banks at the knees. So a bank at that time could do what it wanted, and that's what they did. They advanced credit, and they funded all kinds of development, waterways, seaways, et cetera. They funded World War I that way. But then it became a threat to the city of London, the British Commonwealth. Anyway, the British Commonwealth managed to get control after a while, but for a period, they had this remarkable model where they were just funding everything just by issuing credit.